And welcome to the Aaron Katsman Show. I'm your host, Aaron Katsman. We speak about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think somebody might find this of actual interest, why don't you go ahead and click the share button and you can share it with them as well. So I came across an article, why paying off your mortgage early may be a retirement mistake. And of course, that piqued my curiosity because I think that paying off your mortgage is generally is a very good idea, especially in order to prepare for retirement. So let's see what Mr. Drew Wood has to say. Why does he think this is a big mistake? And then maybe I'll have some thoughts on the idea on his ideas afterwards. He goes, homeowners with a 3 to 4% mortgage who pay down principal early forfeit compounding returns from dividend stocks like Coca-Cola and Procter and Gamble, which each returned roughly 140% over 10 years. A $300,000 dividend portfolio from stocks like Realty Income generates quarterly cash. $300,000 in home equity cannot buy groceries without selling or borrowing. Early mortgage payoff wins only when rates exceed 7%. The homeowner lacks investing discipline, or a retiree cannot tolerate market drawdowns. The standard retirement script, he says, pay off the mortgage before you retire. Sounds something that you've heard here once or twice. The logic is simple. Eliminate the biggest monthly bill and retirement becomes easier to fund. But today's interest rate environment complicates the calculation. A homeowner with a 3 to 4% mortgage may be directing extra cash toward a loan that costs less than the yield available on treasuries and far less than long-term return investors hope to earn from stocks. For a retiree facing a $2,500 a monthly mortgage payment, the challenge is not just eliminating the debt, it is determining whether that capital creates more retirement security inside the house or inside an income-producing portfolio. Home equity and portfolio income solve different problems. Equity increases net worth, but it is not easily spent without selling the house, refinancing, or borrowing against it. Dividend-paying investments, by contrast, generate cash that can be used immediately for groceries, healthcare, travel, or utility bills. A retiree with substantial home equity may look wealthy on paper while still relying on Social Security for monthly cash flow. Retirement planning ultimately requires both assets and income, but the two are not interchangeable, and yada, yada, yada. You get the point. It's like a lot of math. It's a lot of speculation. Maybe, although I didn't understand one thing because he was talking about like Procter & Gamble, Coca-Cola with their interests, with their dividend payment. Then he wants you to use the dividend payments to go ahead and pay for the groceries and the utility bills. So I'm not sure how the compounding works when you're actually spending the income that you're getting. But I digress. As you know, I am a proponent of paying your mortgage early so that you can be free financially. So you don't owe anybody anything. And most importantly, so you have peace of mind that you don't have to worry about if all hell breaks loose, you still own your house, not the bank. You own the house. That's pretty big that he doesn't talk about that. It all comes down to math, right? But when you actually speak and work with living, breathing humans, sometimes there are other issues, like how do they sleep at night? Do they get nervous, right? The calm that ensues after paying off the mortgage. I don't know, Mr. Drew, I'm not sure he can put down a financial number, a dollar sign to that peace of mind the person has. But trust me, actually speaking with actual clients, it actually makes a difference. So what do I recommend? As I said before, broken record, hit play. Here we go again. The first thing you need to do to achieve financial security and have a secure retirement is get rid of all your debt. Sans the mortgage, right? Leave the mortgage. We'll get to that in a second. But get down all of your debt, whether it's loans or, car loans or student loans, credit cards, overdraft in the bank. Get rid of it. Then what do you want to do? You want to build an emergency fund, which is 3 to 6 months of living expenses, so that when your fridge breaks or your Kenwood mixer goes, I'm not sure why I would mention that unless it's something that hits close to home. You don't have to start scrambling, but you have the money socked away, liquid, ready to make the purchase of your new mixer. Okay. Number three, you want to invest for retirement. You want to invest for the long term. There are those who are, I know Dave Ramsey's a big fan. Put 15% of your income into retirement accounts. I'm all for. I'm the more the merrier, right? 10%. And I'm also not opposed at all to putting money. Also, I mean, you should fund your retirement accounts, but I'm also maybe take a different approach. But I think that there is value also in having money in taxable accounts, because later on down the road, it gives you a little bit more flexibility where you take money from, because you can also take advantage of losers and offset gainers and winners and tax-less harvesting. You can do a lot with a taxable account that you can't necessarily do with an IRA, because when you take your distributions out of the IRA, you're paying levels of income. But that's a question already for an accountant. But there are big advantages as well. But I agree, you want to save as much as possible. So we've got number one so far, get rid of all your debt. Number two, an emergency fund. Number three, start saving. Okay, and then go ahead and extra money that you may have. Let's say you have a little bit of money, you get a bonus or whatever, that can be thrown at the mortgage. What I believe ultimately is that we don't know what's going to happen in the future, right? The writing, the guy's thesis is based on the fact that the market always goes up, but the market doesn't always go up. And it wasn't, I remember we had a lost decade, okay? The 2000, from 2000 to 2010 or 2009, however you calculate it, end of 2009, was what we called a lost decade, okay? He wasn't talking about that then. That wasn't such a great idea not to pay off. So my point is, we don't know what's going to happen in the future. So what I sort of believe is that you can do it on two tracks. On the one hand, you're putting money into savings, 10, 15, 20%, whatever you can afford. You put into savings, retirement funds, and what have you. And then anything extra that you come in, you might have money that you're able to save above and beyond that. So you can also put that more into investing. But let's just say you cap your investing at 20%. Anything above and beyond that can be thrown at the mortgage. You get an extra, you get a bonus that can go with the mortgage, right? So what you're ending up doing is you're sort of almost saving. I'm looking at the mortgage as a savings plan, not a great one, but it's a savings plan nonetheless, because you're putting money away every month, and at the end of the day, you have a fully funded property. And since we don't know what the future holds, I think my way is sort of a middle ground, right? It's a less aggressive approach, but it's not putting your hand in the sand either. It's, saying, okay, I believe that markets over time go up, so I'm going to invest. I'm going to fully fund my retirement funds. If I got stuff left, I'll throw some money in taxable funds, what have you. On the other hand, I see the value in paying off my mortgage early so that I can enter retirement. Not just entering retirement, if I pull it off early enough, that's another X amount of money every single month. I no longer have to put to the bank, but I can put towards savings. I can save up for something else, save up for my kids' weddings, help retirement because my expenses just drastically dropped. Throw that money into savings as well when I've now saved for my mortgage payments. Maybe buy another property. Right? The sky's the limit, opens up a whole lot of possibilities for you. So when you save on both tracks, I think you end up at the end of the day, and we don't really know, right? Because we can't fast forward 20 years and see who's right. And that doesn't mean even if whoever's right, the 20 years after that, we know what the story's going to be, who's going to be right? So I believe in saving and paying off the mortgage early. I don't think it's I don't think it's binary. I don't think it's one or the other. I think you can do both. And that's what I strongly encourage. I've always said that. And it gives you both growth of net worth. Again, two tracks, right? Over time, by constantly saving and compounding your interest and what have you, your financial assets are growing. Your what you have in the financial markets, your more liquid money, unless it's in retirement funds, but it is growing. Hopefully, the value of your home is increasing. Certainly, the equity is increasing because you're paying down your mortgage, which is very important as well. And at the end of the day, I think you're going to end up with more money or more net worth at the end of the day with my sort of idea of sort of doing it both two tracks as opposed to the binary option, which the article that I referenced is advocating for. That's what I think. And again, there's no way to know, but maybe mine's a slightly more conservative approach. But at the end of the day, I think you're going to end up with more. You're certainly going to end up with more peace of mind. That's for sure. And that's, like I said, worth its weight in gold without question. And I think a lot of these financial articles, for those who read them, don't take that into account. As somebody who actually works with hundreds and hundreds of living, breathing clients, there's a whole other side to financial planning, asset management, than just, the S&P 500 and dividend stock. There's the psychological aspect as well. Okay? Just because somebody might be able to make a lot more money doesn't mean it's in their interest to go that route. I know that sounds crazy, but you know what? As somebody who's had clients call up during big market drawdowns, calling up hyperventilating, I can tell you right now that, and markets drop and there are big drawdowns, it is not worth it for some to jeopardize their health so that they can get the 11% compounded annual return of the S&P 500 or whatever it is. It's just not always worth it. And some people, that's why we have asset allocation, and that's why people use fixed income in their portfolios. It is what it is. You've been tuning into the Aaron Katsman Show. We speak to you about your life, your money, and your investments. If you like this content, please hit the like button below. If you've not yet done so, shame on you. But go ahead and why don't you sign up for both the YouTube channel and to the podcast, and you can be a subscriber. Woohoo! And if you think someone might find this of interest, why don't you go ahead and share it with them as well. Thanks so much for tuning in, and we'll speak to you soon.